Jason with the California MBA, here with your weekly video update. We are getting so excited for this year's Mortgage Innovators Conference. If we've ever seen a year where we see the value of strong technology solutions, it has certainly been 2020. Last week, we ran our first registration promotion, and this week, I'm happy to announce we're running our second. That's right, register for this conference by Friday, August 7th, and be entered to win another $500 Amazon gift card, compliments of our friends at Insellerate. So don't delay, visit our website today, get registered for that great prize, and also be ready to see a wide variety of technology solutions to help you and your company thrive in 2021 and beyond. That's it for this week, and we'll see you next time.
I want to introduce Josh Friend. Josh is the CEO and founder of Insellerate, a mortgage CRM, and one of the California MBA's President's Council sponsors. And really excited to hear what Josh has to say about both how his company is dealing with the outbreak, and also just, it's one of the things where we want to get beyond the headlines and talk about where industry is and where we see things going in the future. So welcome, Josh.
Thanks, Dustin. Really excited to be here.
Yeah, excited to find out what you have to say. So before we get into what's going on at Insellerate and in the broader industry, I always like to find out what the backstory is of our guest and how they got to where they are. So take us through your journey in the mortgage industry.
Yeah. So I started out in the industry like a lot of folks. I was a loan officer. 1999 was when I became a loan officer. I worked for IndyMac Bank. I had a call center called LoanWorks. So I started there early on in 99. Got a really first taste of this consumer direct world, high volume, lead man, taking inbound calls, leads, and really understanding how that whole side of the business worked, all in the consumer direct world. I then started my first mortgage company in 2003. Started building technology early on for my mortgage company. I was really investing in my own software to make ourselves more efficient. And I've been doing that for quite some time. I've started several different mortgage companies in the last 20 years, had a lot of success. And that's what really led us to build it Insellerate. We built Insellerate for my last ventures I had with People's Bank. And then Insellerate was the system we used to help really grow that organization. And then out of that came other clients and other lenders asking, gee, how did you guys grow so quickly? What were you using? And then we brought Insellerate to basically the mass market about 5 years ago. So I've been in this business for 21 years now. My son now is in this business as well. He's now a licensed originator. As he's working from home, he's been working with me because they're not working in their offices, which has been kind of fun because I've trained loan officers my entire life, and now I'm actually getting to hear my son pitch deals, talk to customers, try to structure loans, and I've been having a really good time being able to kind of give him some tips and listen to his phone calls and say, hey, maybe explain benefit this way, or here's how you should structure the loan, or here's how you should explain the rate, the market movement now, giving him some coaching tips on how he can really talk to his customers. So it's been a lot of fun recently with that as well.
That's great. That's great. Having been able to coach your son on that. It's why I'm coaching my son in Little League right now. We're obviously we're not playing, but been coaching him, and that's fun. So you're kind of a few years ahead of me there, coaching your son in the mortgage industry. So that's really fun. So speaking of working from home, how's Insellerate dealing with all the fallout from the COVID-19 outbreak?
So luckily, if you really look at our company, we're a technology company. We're a SaaS-based, software as a service-based system. All our stuff is in the cloud. So for us, we've always been a virtually set up company in that sense. Meaning all of our technology sits in Microsoft Azure cloud. So we don't need any physical people to maintain that software, to run the networks, the servers, the whole type, all that process, all that physical location somewhere we don't have to go manage. So we haven't really been affected in that sense, other than we don't have, we've been letting our employees work from home. I've been working in the office. We're part of one of the, I forget the term of it, but necessary
businesses,
because critical business, because we help, we're helping banks and lenders. We help manage phone traffic, and we're also, our software is letting lenders work from home. So it lets lenders route calls to people's cell phones, to their desk phones. So those lenders who have loan officers at home, where our phone system's helping them manage that, and also lead management. So I'm still working in the office some, but most of the team is at home. And our lenders right now, we're really reaching out to them, figuring out how we can help them best. What can we do with our technology to expand within the organization to give more people coverage and more management within their platform?
Great. So now it's obviously, too early, way too early to tell, what the long-term impact is going to be. But just from your vantage point, just, on today's, with today's information, what's your sense of, where things stand, where we're going to be long-term, maybe, 6, 8, 12 months from now?
There's a couple parts to that. I think in the broader, just there's the immediacy of what happens of today, what's going to happen tomorrow, next week, 90 days. We have some turmoil. Obviously, we have turmoil because of COVID-19. We also have turmoil in our markets right now with service and values and irregularities and price and swings and mortgage-backed securities. So that's one part of it. That stuff, we think we see that stuff calming down over the next 30 to 60 days. But then as the overall overarching results come out of this, what's really interesting, we're going to see a lot more movement to and faster movement to consumer direct. So the market and consumers, we've already been doing this, and it's been happening for 20 years, right? Amazon, why is Amazon hiring as fast as they possibly can right now? Because people are buying more and more online. So consumers have started this transaction of buying directly from businesses. And now if you're at home, guess what? That's only extended, right? So now if you're a lender out there, if you think about it, your digital strategy today is more important than it's ever been, right? So you don't have loan officers out there working open houses. They're not dropping off, handing out flyers. All that feet on the street type stuff is gone. So it's all digital strategy. And, we're really seeing the market move that way. New York Times came out last week with an article that basically said something to the effect that big technology is going to be the big winner out of this. Because as people are staying home, these routines, I don't know about you, but I can only imagine how many people have ordered food from like Amazon Prime or Instacart, right? And they've never done it before, right? There you go. So you're now, let me guess, you'll probably do that at some level moving forward.
It's really convenient. I can't argue with that.
That's right. So once I've done a few things new. I'm like, oh, this is really convenient. I'll give you an example of this consumer trend in general. And I use this one. Think about, I like clothing brands. Just think about this. So there hasn't been any new clothing brand or shoe line that's been launched in the last 5+ years, minus a celebrity brand. Celebrity brands are always there, but minus that, other than direct brands online. Shoes, for example, like Joybird shoes or the Zix shoes that you can slip right in on your feet. I've bought maybe half a dozen pairs of shoes online now. So take a look at shoe brands for men. There's no new shoe brands going into stores. They're all going on consumer direct. I'm seeing in my Instagram feed. I'm seeing in my Facebook feed. Same with clothing, Stitch Fix, all these things where you can buy a box. They send a box once a month to your house. That box has a pair of pants, a shirt, a sweater, shoes, a whole wardrobe. You keep what you want, send back what you don't want, all consumer direct. So, this movement's already been taking place, and you can already see how it's already happening and developing in our consumers. Now, as it moves more into, you're being forced to do more stuff digitally and online than you ever have before. So we really see this just speeds up the movement to consumer direct. And it's not just, doesn't mean that retail lending goes away. It just means that your consumer is going to be online digitally as well as face-to-face and in person. So having the ability to manage that is becoming very, very impactful. And in the future, it's only speeding that process up. We said in 3 to 5 years, if you weren't strong digital lender, you'd be out of business. I think what this has done is to sped it up by a year or two. So maybe you have 2 to 3 years. In 2 to 3 years, if you don't have a very strong digital presence, digital retargeting, digital management, lead management, understand your data, you probably will have a hard time staying in business because someone else is going to come in and do that better than you will right now.
Yeah, it's amazing. To your point, I just saw this morning an ad on my phone for Carvana, and it's one of those things that I don't know, 2 weeks ago, a month ago, I would have, and I've seen them before, and I've always kind of brushed them off, like, who in the world is going to buy a car, spend $20,000, $30,000, $40,000 on a car and never see it, never smell the inside of the car or drive it, but yeah.
My last 3 cars I bought online. The last 3 cars I bought online. I've been buying cars online for like 7 or 8 years now, and I've bought them out, never went down, never saw them. So yeah, but that's where consumers are going. This is just where but now you can see it right now. You go, oh, if you need a new car right now, do you want to go down to the car lot and go touch all the cars?
No, I agree.
You don't. And you pretty much now know what they all look like. You pretty much now know what they all are inside. I mean, so this is just, it's only, and then with the 3D pictures, you can get a virtual tour inside of it, and you can even color, you can change the colors online. You can make it black or blue or red or green and change the interior colors and see exactly what the car would look like. That's the experience. So to the point, that's the experience that consumers expect. And what's they don't just expect it in one area. It's not like, oh, we want to be able to buy cars that way, or we want to be able to order groceries that way. But when it comes to a mortgage, I want to come in and I want to photocopy a bunch of papers and sign a bunch of things, and I want to have you send me sets of disclosures 6 times, and take 45 days, and I have to call my accountant, and I have to call my HR person, and I got to go to the bank, and I have to. No, consumers aren't going to expect or want that, right? That has to change as well. They both have to change.
Yeah. So, speaking of that engagement, where do you see that, lenders are doing the right thing when it comes to borrower engagement, and where do you see, where there's, where we need to improve as an industry?
So I think one of the things that lenders really fail to do is understanding their customers and just engaging in general. Meaning, if you have a customer who comes to your website, calls you, applies, raises their hand in some way or another, you need to have that person in your database, and you need to stay in front of them for their life, right? Building customers for life means staying in front of your customers for life. The MBA did a study a handful of years ago, and it said 1 in 4 borrowers went back to the original lender. So 75% of the time they go with a different lender. However, in that study, they interviewed the people, and they said over 50% of the time, the consumer would have went back with the original lender. But the response was they weren't there when they were looking for the refinance or a new loan. So it wasn't that it wouldn't do business again with the same person. It was just, hey, I did this loan. And then think about this. If I did a loan with you and I gave you, let's just talk about how many people do you want to give your social security number to, your income, and all these statements? There's not a lot of people I feel comfortable giving all that information to. So if you, Dustin, and I, we did a loan in the past, and I gave you all my financial information, and I felt safe and secure, and it was a decent transaction, and you and your company come around the next time around, do I really want to give that out to someone else new if I don't have to, or would I rather do business with the same person I did business with in the past? Usually I will do business with you again, Dustin, because you helped me with my largest financial transaction. The average American consumer, largest financial transaction they'll have is their home. So if you helped me with that in the past and did a good job, why would I give you the business again the second time around, the third time, or fourth time? Well, the reason is you're not there when I want the loan. And the reality is I'm selling a commodity. So like you did an example of selling the car. Well, why can I buy a car online? Well, I don't have to go to the Audi dealership or the Ford dealership to look at the Ford F-150 truck and think it might be different than the Ford F-150 truck I get from the other person, down the street. We know it's the same truck. We're selling a commodity. Well, the mortgage is the same way. If I'm calling you saying I'm buying a house and putting 20% down, I want a conventional loan, it's the same thing from you, for someone else. Fees and rates, they may be plus or minus net to a borrower $5 a month. We're not talking over the life of a loan. One lender may be $2,000, $3,000 cheaper than the other or more, and over 30 years, that's not a lot of money. Really, we're talking really small. So it's service. It's service and
prices.
Service and convenience, right? Service and convenience. So if you are in front of me when I'm buying that next home, because you have stayed engaged with me. And so here's the things about engagement that borrowers or lenders aren't doing like they should. A real simple one, like website retargeting. If someone goes to your website and looks at your webpage, it's very easy to drop a cookie on their desktop. So anytime they go to any other web pages, they're searching around, you can display an ad to them. Matter of fact, you can even get as tricky as saying, you can call out your top competitor lenders' websites and say, anyone who goes to these websites, I want to retarget these people on Instagram, on Facebook, on LinkedIn, and on Google AdWords. You can actually find people who aren't necessarily going to your website, but are going to your competitors' websites and engage them. And then once someone raises their hand, we've all seen this. I bought those shoes online because I saw the ad on Facebook, and then saw it on Instagram. I then saw a desktop version of the ad. And I started seeing these ads everywhere. And so I went, well, all right, so if this shoe company has this many ads, and they look like they're good ads, they were like nice ads, and they had reviews again. So all the techniques that anyone wanted, they had reviews about people who liked their shoes. and this digital transaction. They were all around me. I saw them in all of my different feeds. They felt like it was a brand. It built brand right in front of me over, a 30-day period. I bought the shoes because it was, I knew who they were. It was easy to deal with. Same thing with being a lender, right? If I raise your hand, if you're a real estate agent and people are going to open houses, now it's a little different because there's not as many open houses, but maybe there's a digital version of open house right now. But if I go to an open house, why wouldn't I put you in some type of database, right? Like people use our engagement platform. And our system will email, text message, ring his voicemail, Facebook, Instagram, do direct mail and phone calls, and engage these consumers forever. So I think that's one of the biggest things that you need to learn. And you can take a page book out like an Amazon or any of these large online players. Once you're in their database, they're marketing to you. They're staying in front of you. I got direct mail from Amazon about a year ago. I was an Amazon Prime member, and I never used Amazon Prime Video. And I got this piece of mail in my mailbox and it said it was from Amazon. And I'm like, interesting. I'm going to go and open it up and read this because it's from Amazon. And the letter said, very simple. Dear Josh, you've been an Amazon Prime member for over a year. We've noticed you've never logged into using Amazon Prime Videos. If you're not aware, Amazon Prime Videos is free with your membership. And it gave me like 3 titles. You should check out this one, this one, or this one, 3 shows. And I went and I actually started watching Amazon Prime Video. Now, the truth to be told, I've got emails from Amazon Prime telling me the same thing. I've seen banner ads about Amazon Prime knowing I had this, I could do this, the same thing. It wasn't that I was unaware. It wasn't that they hadn't marketed it to me before. It's just all of a sudden now I got this piece of direct mail, and within 24 hours now I watch Amazon Prime Video. So having the ability to engage consumers in all these different mediums, I think, is what's really powerful today. And that's what lenders can do, right? So use a platform like ours where we get the experience. They're going to get emails, you can get a phone call, you can get a Facebook ad, you can get an Instagram ad, you can get a voicemail, and you can also get a direct mail piece. So actually engaging all these consumers so that whenever they're ready to buy or transact, you're in front of them. That's kind of the key to it, is you stay in front and be relevant. You don't want to just, it used to be we emailed people and we emailed them all the time. 5 times a week. Got really annoying. Yeah. People, or then it was text people. Text them all the time. Well, you can't email everyone every day and you can't text everyone every day. You have to have different means of communication. You look at Amazon, look at any of those, you're going to see the same experience. You're not going to get emails from them every day. You're going to get different modes of communication. They're going to engage with you and be there when they're ready to buy, when you're ready to buy.
So if you're not, if you don't have the power of, the data power of an Amazon or Google behind you, though, how do you, as an LO, as a former LO yourself, how do you, organize and stay organized with all those different forms of communication today?
So 2 ways. One, you can work 20 hours a day and get really good at it and do lots and lots of work, lots and lots of spreadsheets, create lots of content, creative strategy. Or 2, you can come to someone like us. Right? There's technology out there right now. We have turnkey solution. You don't have to do all this work. We have all the integrations built. We have the strategy built, and we actually have the content built for it as well. So you can come to someone like us. We're a lender. If our lenders can come to us, you start using our software. We automatically do all this engagement for you. You don't have to do the heavy lifting, which is why we're really excited just about software as a service in general. Same reason why we're able to work from home. This whole cloud compute and software as a service. If you're a lender, the amount of money it would cost you to build the content we have 2 years of strategy. It would cost a lender to go pay someone $250,000, maybe $500,000 to write all this content. It's a lot of content. And then it would take a lender, I probably spent 50 to 100 hours of my time just going through strategy, going through all the data we had. And that was just me. I have a whole team. They were doing the same thing, but I had that many meetings going over a strategy of when should call, text, going through the data. So that would cost lenders, when I was a lender, I didn't have this. I wish I did. Someone would come to me and I would have done this, but I didn't have the resources or time to do this. Software as a service, we have lots and lots and lots and lots of lenders who are all paying, so everyone's able to leverage that. So you don't have to pay the $1 million a year to use software like this. You can pay the $50,000 a year, and because you have there's 100 other lenders who are paying for the system, if you will. So really leverage
data and the strategy fresh too. There's no way you could manage that on your own, just with your sort of as a Lone Ranger doing it yourself.
Yeah, you can. Yeah, it'd be too hard to figure out what message to give to who when. On Facebook, you'd have to. It would take you all day long take you 20 hours a day, every day, 7 days a week, just to try to get this data out if you're doing it manually.
My question is always sort of, what do you see next, or what's the big, breakthrough that we're going to see next? And the last year or so, I've heard, almost 100% of the time to a person that it's not, the question shouldn't be about what's next. It's really a question of how we deal with the existing technology. We've got great technology now. It's just a matter of, integrating it, organizing it within their, existing tech stack. What's your take on that?
I think you're absolutely right. We have, there is part of the challenge in the mortgage industry is our technology is old. Let's just say, and the reality, the LOS system of that, Ellie Mae, over half of all loans go through Ellie Mae's platform, right? They're obviously clearly the market leader, but some of their software was built in the 90s, right? So it's just, so the challenge is, now it's obviously it's completely functional. It 100% does the job, but then what you said was right. The integrations of the different pieces of technology, that's where the struggle has really come down to, is because some of these systems were built such a long time ago. The data structures, whether they really have APIs or not, all these things have made integrating technology more difficult. So you're right, lenders, it's not about we need to create something new. Now, the new thing I think will come into the industry, it's not even necessarily a new thing, it's already in existence, is AI and robotics. But that's already an existent technology out there. And all that really comes down to is someone integrating that into our current technology stack. You're absolutely right. So give you an example like an LOS or a point of sale solution. So you have point of sale solutions and you have LOSs and you have loan officers. And you have a loan officer who may start a file in the LOS on borrower Sally Smith. Sally Smith may also go to the website and start applying. And then me as a loan officer got an automated email that says, hey, Sally, use my link to my point of sale solution and start applying for an application. All of a sudden, they click on that. I could potentially have 2 or 3 Sally Smiths in my database. And so then how do I coordinate that all together? So those are struggles. Or the data flow from one system to the next, or data validation. Or, I'll give you an example like in servicing. We have lenders servicing clients. Having access to that service and data is invaluable if you're a loan officer and you're trying to refinance someone. Even go as far as integrating the service and platform, the service and phone system into one technology stack to where if you're a servicing client, you call in, one of our lenders is doing this now, been doing this for a couple of years, you call into the servicing client and phone number because you have a question about your payoff or something. That servicing system and phone system gives us the data, it's integrated through our platform, tells us this number is 714-536-1212. We look at it, or if they collected the loan number, if the consumer punches in the loan number, tells us that information, we look at it and say, oh, this person's in the market for a refinance. They've been highlighted for refinance. Instead of sending that call to the servicing group, let's route that call to our loan officers. Now, when the loan officers take the call, they actually have a servicing screen because their systems are connected. And they also have access to Encompass because they previously Encompassed because all the systems are connected. So now I'm a loan officer. I can talk to you and say, oh, let me answer those questions about your servicing. What did you want to know? Oh, what your payoff is? I have your payoff, and this is all done through our platform. Shows them the payoff, escrow balance, whatever it may be. It looks like you might be able to refinance. You look like you're in the market. Let me go ahead and start a new transaction for you. If they say yes, great. I already have all your loan file. Are you still working at Smith Elementary School there in Huntington Beach? It's all right in front of them. They hit another button, and then transaction starts. So that's the kind of experience, and what we talked about buying a car, or consumers expect better experience. That's the kind of experience that really is what it comes down to, is how do you make all that work seamlessly? And then the same thing with the engagement side and the marketing side. To make the marketing work like we talked about earlier, you have to have all your data integrated and all the systems working together, right? So we look at some lenders, they have a point of sale solution that sends out emails, a LOS system that sends out emails, a third-party CRM type system that sends out emails, and then like a fourth system that's an email platform. So they can have like 3-4 different systems that are trying to message these customers. How can you have consistency of message, of brand, of timing with 4 systems? You can't.
Yeah.
So you really need a central place to manage, to view all this data, and to manage all your transactions. And that's where stuff like Insellerate comes in. Right? Not only do we have CRM engagement, but a lot of lenders use us and really benefit from our ability to tie in a service and platform that's 20 years old, that doesn't have an APIs, but can give us some type of nightly FTP download or can give us real time, like it could be very chaotic that we can get out of that side. We can take that data into our platform, normalize it, and then the LO system sits over here, and we can pass information back and forth, or to the phone system, or the pricing engine, or to the whatever it may be. Having that platform that can really take in a lot of different data, but then also have like what I call decisions around that data. So if a loan amount changes over here in this system here is watching and monitoring. Oh, loan amount's changed. Let me go ahead and tell this system to do something else. So instead of trying to go in there and and this is the struggle to your point of integration, you can't go in there and integrate 7 systems to one another, right? They're not going to all talk, and it'd be really difficult. Then you'd have to have some way to like a master in there saying, well, of the 7, who's the owner of the record, who's right on the record, who does what. So it's you can't do that. So now you use something like what we've built, and it's just part of one of the things that our CRM and engagement platform does, and it's what lenders, it's an added bonus, if you will. You now have the platform in the middle that can do all that, can see all these different systems, can read the data. Now you can build it yourself. So if you want to, you go out there and try to build something like this yourself. But having that integration, you're absolutely right. That is the next biggest thing. If I get a call, we all have this experience. I call the bank, I give them my bank account number, my information. They ask me some questions, and they say, "Hold on, I need to talk to a supervisor." And they transfer me to someone else, and they ask me all the same questions again. It's a horrible experience.
Yeah.
Right. But we as lenders do that over and over and over and over again to our borrowers. So using integrated technology, so you have all the access, all the information. Shouldn't ask you. I did a loan for you a year ago. I shouldn't have to ask you what was your original loan amount. I did a loan for you. I shouldn't ask you, where do you work? I should ask you, are you still working at such and such? Right? I should ask you, are you still banking with Bank of America? Are you still banking with Chase? I should ask you these questions versus trying to get the information from you, because we all have that experience. No one likes to try to give it twice. I don't like giving the bank information twice, and they go, I just told so and so, I just gave them all this information. Now wait, I got to give you my mother's maiden name all over again. I got to do all this.
After you've been on hold. Yep.
After they've been on hold, right? Again, I think the biggest change in just consumers, and Amazon's highlight this, is make the buying process easier, and they will buy from you over and over again. We want convenience. Consumers want convenience over pretty much convenience and security over anything else. We want our convenience and security. We will trade up convenience, for example, cell phones. The idea of 20 years ago, you having a GPS on your cell phone, because I was in that space. People, and we had worked on some technology, had some GPS technology on it where people could actually locate you on your phone. 20 years ago, consumers were like, no way.
Oh yeah.
I do not want someone knowing where I'm at. I don't want a record of it. But then all of a sudden, Google Maps came into play. Ooh, this is convenient, right? Now it's convenience. It's easier for me. Now I go, it knows I'm getting home. So now all of a sudden, we don't mind the security or privacy that we once had, because it's convenience for us. So we traded our privacy of our phones not knowing we are for the convenience of it being useful for us. So consumers, same thing will do with buying mortgages. Those lenders who make the transaction the most convenient are going to get more business, and over the next 10 years will grow and stay in business. Those lenders who do business the same way they've always done it and don't adapt and change right now won't last. They can't last. Every other business, you look at Sears, is out. I mean, the stories of people have not changed to what consumers are buying, how consumers are changing. There's a graveyard of big businesses that are out of business because they failed to change. And there's people like Jeff Bezos, who's now one of the wealthiest people in America in 20 years because he didn't do anything new. Really, all you're doing is you're buying stuff from him, and he just made it really, 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 really easy for you to buy from him. You're buying a commodity. It's just convenient now.
He essentially took the Sears catalog and just made it online and made it convenient and easy. I mean,
that's right. That Sears was the original. I have a whole speech about this. Sears was the original Amazon. They were the original people to do online. They just failed to use technology. And we have lenders right now that say, well, I have the greatest loan officers in the world. They have the best relationship with the real estate agents. I mean, these people have been producing me for 20 years. It's just fantastic. And, the bright side with some of that is we're going to have a lot of loan officers that are retiring in the next 2 to 3 years. So as the shift takes place and as consumers buy more and more online, and those loan officers and lenders who haven't gotten digitally, the retirement may just take care of, instead of people going out of business, the retirement age will probably just will kind of even itself out. So I think that's, I don't think we're going to have a massive, reduction of workforce in our industry. We just won't rehire all those people, as the market changes.
Yeah. Well, and to your point, I mean that will, you're going to have all these younger LOs and professionals that don't have those existing relationships and can't just rely on those long practiced methods of reaching borrowers and their realtor partners. So to your point, yeah, I mean you need something like this that will keep them engaged and in front of the borrower. So on that point about younger borrowers, you started your business, you got involved in the industry at a younger age and started your business at a youngish age. What would be your advice to someone young in the industry who's looking to find ways to get engaged and get involved, and what do I do?
So I mean I'll give the same advice I gave to my son, which is be educated. First, be educated, learn. Absorb these things. When I first got in the industry, I don't think I was paying attention to understand how the mortgage-backed security market worked. I wasn't paying that much attention to it. I didn't understand the difference between the Treasury, how the Treasury worked, the 10-year versus the Fannie Mae coupons, and how they aren't always work lock stop together. But I didn't understand the market. I didn't understand how the secondary market works, servicing work. There's a lot of things that you can be educated on. So first and foremost is if you're in this industry, if you're gonna make this a career, be professional about it. Be educated about it. Learn. Watch webinars like this. Watch other webinars. Go to trade shows. Trade shows, meet people, network. Right now is a great time if you're young. Network now, because the people you're working with today, the relationships you're working with today, and I can look back now, I go, oh, I know. I remember 20 years ago, I was a loan officer with so-and-so, and now they're running this mortgage company. I have 5 different mortgage companies that I know of from that were all former employees of mine. 15 years ago, 5 different people. I still have mortgage companies that are up and running mortgage companies. They were once loan officers of mine. Now they're running companies. And I worked with some of these folks too, and other folks. So just that networking people, get involved. We're sending one of our folks to your Future Leaders program. I think that's a great thing to do, right? Go to, do the California MBA has a Futures Leaders program. You get involved in there because you're going to meet other people in the industry. You're going to learn more about this industry, and it's going to make you more professional, right? So that's just, if this is going to be your career, study it, because you didn't learn about this in school, right? There wasn't there wasn't a class in school that taught you about how this all works. And I've been doing this for 20 plus years, and I'm still learning. It's not like you can learn it all in a day. So be a constant learner. Learn, read, really, get involved. Get involved with trade shows. Get involved. There's books to read, and there's also committees you can get involved in as well. All those things are just really just jump in, get involved, make this your profession. Don't just work Monday 9 to 5 and go home and do something else. Get rid of one of your Netflix binge shows for a month and read.
Let go of Tiger King. Is that what you're saying?
Well, I don't know about Tiger King. That's a tough one. But maybe not. Yeah. Let go of Tiger King let go of something and just study and learn, right? So, that's what I could say is learn about this business so you're educated and you're professional and you understand how the industry works. Because I will tell you, there's a lot of ignorance out there. I mean, there's a lot of just people, and I'm not trying to knock the people of the ignorance, because, my son I was talking to him about something, and he gave me something about pricing and a loan. And he's like, yeah, I don't think that's good though, Dad. And I'm like, well, actually, that's not true. Let me take you back through it to, we had to walk back from start to finish, and it was like, oh, that's very different than I thought it was. So there's a lot of ignorance out there, just, in the marketplace. So just be educated. I think is really, one of the biggest things. Be educated and get involved.
Right. Well, and to that point, I mean, you guys are members of the California MBA and President's Council sponsors this year, and thank you very much. Yeah. So one thing that I hear, often from potential members and even some members sometimes, they don't necessarily understand or really value or get the power and the importance of our advocacy program at the California MBA. That's really our, from my perspective at least, that's the number one reason why we exist. I mean, we're not a for-profit conference, conference show organization that exists just to put on networking shows. And we really have a purpose in our advocacy. So what would be your advice to, a colleague or someone in the industry that maybe just doesn't, thinks that, someone's going to do that advocacy work, but, I don't know how important it really is.
Well, first, I mean, we talked about this earlier. When it comes to our government, in our country, our government's made up of us, the people, right? So if we don't go out and we don't advocate for our industry, who's going to advocate for our industry? We have to advocate for industry. I've been in this business for 20 years. When I went through the whole market meltdown, and out came Dodd-Frank, who was in there, being an advocate, saying how should we really make these disclosures rules? Are these really effective? Are they really helping us? And today, we've talked about this before. They didn't really help us. I don't think that all these disclosures rules necessarily has given our industry protected any consumer. The last study I looked at, it cost the average consumer, I think it's $1,200 more every consumer now pays for a loan because of compliance needs. Right. And that was because what they wanted to do was catch unscrupulous lenders who would send someone a good faith estimate, which we no longer have that. Now it's, the LE and it's a different name, but they sent a good faith estimate, and maybe they said the title fee was $500 and really it wanted to be $900, or they would, bait and switch, which was not right. That's a bad practice. So now let's do this LE and CD, and you have to guarantee these fees, and that way, that won't happen anymore. Well, the reality is, unfortunately, there's a lot of unscrupulous lenders that they're just now canceling the file, starting a new file, and changing the fees. So those bad players aren't necessarily out of the market, but what's happened is now every consumer pays for it, right? More money gets paid by our consumers than consumers maybe potentially lost in the begin with. So I'm not saying we don't need regulation. I'm not saying we don't need to understand and protect consumers, but what I'm saying is we need more people who are actually in the trenches of doing loans, right? When I was involved with People's Bank, we had some issues with a regulator on just some pricing things about how we price to the market. And I can tell you, being part of that organization, we weren't doing disparaged pricing or any. It was very, very clear, very cut and straightforward. It was just, we realized that the regulators didn't understand how trades were made, how secondary market trades were made. So they had it. Well, we don't understand why were these locked this day versus that day, and the hedge. And it really was nothing to do with anything bad to the consumer. It just was ignorance on the part of the regulators that didn't understand how the mortgage market worked. So they had to be. There was a whole explanation period that took a while to explain to them. Let me tell you how this works: how we lock loans, how we close loans, how we fund loans. And once they understood it, they're, oh, okay, this makes sense. But it still took time, money, and resources for them to edge. So if we don't do it, who's going to tell them?
Yeah, well, and most regulators that I've been in and around, or been in front of, and we've been in front of in the past. They want to know. Most of them don't come to the whether it's the Department of Business Oversight or real estate or another regulator. They don't necessarily come in there directly from the mortgage industry, so they may have a lot of knowledge about financial markets in general, or they may not. They may just be, in a sense, a political appointee. But when they actually do get in front of our actual lenders, our lobbyists and our advocates do a great job. They really do on a day-to-day basis. But nothing really does. Nothing's a substitute for having actual mortgage lenders being in front of the regulators and tell them what you're, the regulation that you're considering. This is how it would impact my business on a day-to-day basis. How it would affect the employees, the customers, the access to credit. And so, I appreciate that. I think that you make a good point that there is a ton of ignorance, and it's not willful, it's not bad, but it's something that we need both lenders to just make sure their folks are getting involved, and both at the national level and here in California at the state level. And so that's great. I appreciate that.
Well, especially if California, I think it's 25% of mortgages in America come through California. So obviously, this is 1/4 of the mortgage business in the country. Then this is definitely a very impactful place to spend time, right? Is in California at the California MBA, because this affects so many of our consumers.
Yeah, well, and a lot of the regulations and bills throughout the nation, their genesis is really in California. Stuff that is done here first, the other states will sort of follow in many respects. And so it really does make if you're a multi-state lender, or a business like yours that operates with lenders that are multi-state, it really does pay to invest in what's going on in the legislature here in Sacramento, because a lot of that stuff you'll end up seeing in, every state in the rest of the country.
Yep.
So as we end here, I want to make sure we end on a positive note, or at least a hopeful note. So what would be your thought, closing thought, or a tip to lenders on how to sort of navigate the next few months? Something maybe they're missing, something that we can leave everyone on a positive note.
So one is just, I would say, education, communicating to your staff, your loan officers, of just the impending changes, what's going on in the marketplace on a daily basis. If as government loans are starting to change, explain that to them so that they know how to explain it to their consumers as well. But on a positive note, rates are fantastic where they are. If you really look at where the marketplace is at, lenders have had 6-7 months of fantastic pipelines. So we will have a 30-day hiccup in our marketplace. But the truth of it is, their pipelines are so big, there's so much volume out there that I don't see this becoming a long extended problem for any of our lenders in the marketplace, because they're still just trying to catch up from the pipeline they locked 2 months ago. As the market changes, it'll even itself out. But lenders, just now's a really good time. Again, think about the data and all the people you touch and the value that's there. Right? Just they're right now. I guarantee you, all these lenders, there's hundreds, if not thousands, if not millions of dollars of value in their data if they could make it actionable. So all the past loans, past hand raisers, in a market like this, if rates one day are really high because of the market fluctuation, and then 2 days later they drop by 0.5%, having a system in place that you can all of a sudden hit a button and message everyone that says, give us a call now, rates are better. So that technology is out there. That's something that's easy to do. And those lenders who use that technology and capitalize are going to grow. There's going to be some major winners over the next 12 months that come out here. I wouldn't be surprised if in 2-3 years from now, the top 20, 30 lenders, there's 1 or 2 new players in that group, just because of their, I can tell you there's some lenders in our platform. One of our lenders who's grown unbelievably over the last 2 years. He's like, Josh, I'm doubling down. I'm hiring more. They already bought 4 months worth of computers, so that they want, just in case there was a stall getting supplies, that we're hiring more people, we're doubling down. They're doing great, and they'll probably be one of those people that pushes out and comes in, 2-3 years, you see their name in the top 20, 30 lenders in America. So there's lots of opportunity, and anytime there's market turmoil, there's opportunity. So those lenders who just pay attention and look for that with opportunities, look at your data, that might be the best place to find some opportunity right now.